This is a stock alert, diving into a unique situation. And I'm not talking about some obscure penny stock nobody's heard of. I'm talking about a company whose name, in Sanskrit, literally means progress. The irony? The market hasn't progressed past ignoring it. But here's the thing. The numbers just dropped, and they tell a completely different story. Stick with me for the next 5 minutes, because by the end of this video, you'll understand something the market hasn't priced in yet. Let's go. So, what's actually going on here? March 2026 quarter results just came in. Revenue? 2,553 crore rupees. That's a 15% jump year over year. Now, 15% revenue growth doesn't sound crazy on its own. Lots of companies post that. But here's what makes this unusual. This is a textile company, a mid-size B2B fabric manufacturer, not a tech startup, not a pharma company, a business that makes and sells fabric. And it just posted its strongest quarterly revenue in years. While most investors are chasing the next AI stock or the next IPO, this company quietly grew 15%. The market barely noticed. Here's something most people don't talk about enough. India is in the middle of a multi-year textile export boom. You've heard of the China Plus One strategy, right? Global brands, from fashion houses to retail giants, are actively reducing their dependence on China. They're diversifying supply chains. And India is one of the biggest beneficiaries of that shift. Now, within India, who benefits most? Companies that are already set up, already scaled, already supplying to global brands, not the ones trying to build capacity from scratch. This company is already there. They're a B2B fabric supplier. That means steady, recurring demand. No one-off customers. No project-based revenue that disappears next quarter. When a brand needs fabric, they come back quarter after quarter. And here's what's happening right now. Exports and domestic demand are both firing simultaneously. That's rare. Usually when exports boom, domestic softens, or vice versa. Not here. Both are growing. What does that mean for margins? Operating leverage is quietly kicking in. As volumes rise, fixed costs get spread thinner. Margins expand. Slowly, steadily, but it's happening. Textile is boring, I know, but that's exactly why this opportunity exists. Nobody's paying attention. Okay, this is the part I really want you to pay attention to. This is what the market is missing. Here's the headline number everyone sees. Net profit grew just 3% year over year. 3%. That sounds fine, unremarkable, nothing to get excited about. And that's exactly why this stock is being ignored. But here's the number almost nobody is talking about. EBITDA, earnings before interest, depreciation, and tax, grew 25%. Let me say that again. Operating profit, the actual business, grew 25%. Net profit, what shows up on the bottom line, grew 3%. That gap is the insight. So where did the other 22% go? Interest costs, depreciation, debt repayment. The company is carrying meaningful debt on its books, and that debt is eating into the profit that the actual business is generating. But here's the thing. Debt gets paid down. Depreciation is a non-cash charge. These are not permanent drags on the business. The operating engine is running at full power. The P&L just doesn't show it yet because the financial structure is masking it. Think of it like this. Imagine a factory that's producing at full capacity, making great products, generating strong cash flows. But the owner took a big loan to build it. Right now, the loan repayments are eating the profit. But once the loan is paid, same factory, same production, profit explodes. That is the setup here. The market is pricing this stock based on weak net profits. It hasn't priced in what happens when debt normalizes. That re-rating, when it happens, is where the return lives. Let's run through the numbers quickly, because they tell a clean story. Revenue. March 2025, 2221 crore. December 2025, 2373 crore. March 2026, 2553 crore. That's consistent sequential growth, not a one-quarter spike, a trend. EBITDA. March 2025, 245 crore. December 2025, 273 crore. March 2026, 306 crore. 25% jump year over year. That's a big jump, especially for a capital-intensive business. Net profit. March 2025, 155 crore. March 2026, 165 crore. 3% growth. And I know, that sounds weak, but now you know why it looks weak and why it won't stay weak. EPS, earnings per share, moved from 5 rupees 77 to 6 rupees 9. 6% improvement year over year. One final number to note, the EBITDA margin. At 306 crore on 2553 crore revenue, that's an EBITDA margin of about 12%. For a textile manufacturer, that's healthy, and it's expanding. That's the direction that matters. So what needs to happen for this stock to move? 4 potential triggers. Let me walk through them fast. 1. Export momentum continuing. The China Plus One story is not a one-year trade. This is a multi-year structural shift. As long as global brands keep diversifying supply chains, Indian textile manufacturers with scale and quality, like this company, keep winning orders. The runway here is long. 2. Debt reduction. This is the big one. As the company pays down debt, interest costs fall. The same operating profit that currently gets eaten by interest payments starts flowing through to net profit. The EBITDA growth is already there, 25% proof of that. The question is just, when does it show up on the bottom line? The answer? As debt reduces. 3. Analyst coverage or institutional interest. Right now, this stock is flying under the radar. If one decent analyst initiates coverage, or one institutional fund starts accumulating, the re-rating can happen fast. Small caps with improving fundamentals and no institutional ownership are where multi-baggers are born. 4. PLI scheme tailwind. The government of India has production-linked incentives for textiles. If this company qualifies and benefits from PLI disbursements, that's direct margin improvement, essentially free money from the government to reward production scale. Any one of these triggers firing could move the stock meaningfully. All 4 together? That's a different story entirely. Now, I have to be honest with you. Every story has a catch. And this one's catch is real. Debt. The same debt that's masking the operating strength today is also the risk if things go wrong. If revenue growth stalls for even 2 quarters, if cotton prices spike and margins compress, if interest rates stay elevated longer than expected, that debt burden becomes a problem, a real one. And there are 2 more things worth keeping in mind. Textile is a cyclical sector. When global economies slow down, discretionary spending falls, and fabric orders slow with it. Also, net profit growing only 3% while revenue grows 15% is a ratio that needs monitoring. It can't stay this way forever. If operating leverage doesn't translate to bottom line improvement in the next 2 to 3 quarters, the thesis needs revisiting. These aren't reasons to run from this stock, but they're reasons to go in with eyes open. Size your position accordingly.